Hey, my name is Jeff Baxter, and I am a financial analyst at MidStreet Mergers and Acquisitions in Raleigh. We're hiring some new staff members in the financial analyst / due diligence role. So I wanted to make this training course to help teach them everything they're going to need to know about valuing small businesses. But we're also going to publish this course online. So if you're a business owner, somebody who's interested in small business valuation, business school student, anything where you're going to be valuing a small business, privately held business, this course will teach you some of the things to consider when you're going through that. So let's jump right in. So the purpose of this course is going to be to teach you about how to value a small business that's for sale. So the techniques differ a little bit between businesses that are going through litigation, if the owner's going through a divorce, partnership disputes, if they're trying to get financing, any of the other reasons that you might get a business valuation. There's some differences there, so we're going to focus primarily on how to value a business that is going to be for sale. We're also not going to focus on an individual buyer, a private equity buyer, or a strategic buyer, but we will talk a little bit about how the specifics of the business impact what buyers might be interested, and then what you need to know about if you expect a private equity buyer, how that's going to slant the valuation, or if you expect a strategic buyer. So giving a basic conceptual overview of business valuation, the course is going to talk a lot about two things primarily, and they're the two things that you really need to get straight to come up with an accurate value, and that is cash flow and the multiple. So like most investments, businesses are valued based on the cash flow that they generate for the owner. So if two businesses are in the same industry, in the same city, doing the same product or service, say two landscaping businesses, there are some minor details, but generally speaking, if one makes $500,000 a year in profit and one makes $1 million a year in profit, you can expect that the one making $1 million a year is going to be worth roughly twice as much. That's not perfect, but that is generally true when it comes to businesses in the same industry, with similar characteristics. So it's really important to get an accurate idea of what the cash flow is. The problem is cash flow is a really loose term. There's a lot of different definitions of it, different opinions on calculating it. So some of the questions that we'll answer throughout the course are, what's the right definition of cash flow to use for this business? What if the cash flow is changing substantially? How do you pick the right number? If the cash flow is 500, then 700, then $1 million, then 500, how do you pick the right number? What if the business owner has personal expenses running through the business, like their meals or their phone or their car? How's that going to affect the value? And once you figure out the cash flow, how do you come up with a multiple to use that's going to accurately reflect what somebody is willing to pay in the market? So those are some of the questions we're going to answer throughout this course. The primary decision, though, the first thing that you really have to decide when you're doing a valuation is between the SDE model and the EBITDA model of small business valuation. And so they both work the same way. They're both a measure of cash flow or a measure of earnings that then get applied to a multiple. But they're very different in the way that you understand them. So we're going to dive into this in a lot more detail in the coming videos. But just giving a broad overview from the MidStreet blog, SDE represents the amount of money that a small business would pay a full-time owner-operator. So if you owned a business and you went and worked there full-time, 40, 50, 60 hours a week, and you were in there paying yourself a salary, what would the business earn in discretionary cash flow for you? So after all the expenses have been paid, what are you going to get? And this is before any loan payments or anything like that. EBITDA, on the other hand, is typically used with slightly larger companies, typically doing over $1 million in earnings, and is most commonly used by private equity buyers and strategic buyers who might be bringing in a management team. So EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a measure that's gotten flack from some people, like famously Charlie Munger, because it doesn't take into account things like capital expenditures. But for the purposes of valuation, that's okay. Pretty much everyone uses it above a certain size until you get into the public market stuff. So, if you're reading a book on business valuation and it's talking about $75 million, $100 million companies, chances are you're dealing with EBITDA. So we're going to go through in detail how to calculate both. We're going to do examples where you can see the same business with an SDE model, the same business with an EBITDA model. And so stay tuned for those videos. But if you're looking for information in a written format that's easily digestible with examples, check out this MidStreet blog post here linked at the bottom. Or if you just search SDE versus EBITDA, it should be the first thing to come up. So in this course, we're talking primarily about businesses that are between 1 to 25 million in revenue. So we typically don't deal with businesses at MidStreet below 1 million or over 50 million, but this course is primarily designed to get people started in the 1 to 25 million dollar range. These techniques do work for businesses outside of that range. They're the same that you would do for a $50 million company or a $500,000 in revenue company. But the examples I'm going to use are going to try to stick within the range that we deal in. We've deemed this range the MidStreet size, so you'll see that on our website and in the verbiage that I use, because it exists between Main Street, which is anything less than $1 million, and the lower middle market, which has various definitions, but you could say it starts at 30, 40, 50 million. So, MidStreet is between Main Street and middle market. And the techniques that we talk about in this video are specific to MidStreet businesses. So it's also specific to businesses that deal in tangible goods and services. So home services businesses, manufacturing, CNC machine shops, healthcare, stuff like that. It's not wrong to use this for a restaurant or a professional practice, but there are other valuation techniques that tend to be used in those industries. And it's probably wrong to use these techniques for something like an Amazon FBA business or if you had a startup. That's not the types of businesses we sell, and I'm not too knowledgeable on that, so I wouldn't use this information for valuing those types of businesses. There are a lot of carryover, but I'm sure there's good courses on valuing startups or e-commerce stuff. So jumping in to some of the details on when we work with companies, we typically work with businesses when they're considering a sale. So when we value, we're going to look at when do they want to sell and how does that impact the value. So some of the times we're dealing with business owners 60 days before they sign a listing agreement because they're ready to retire. A lot of the times, though, our valuations are for business owners who are thinking about selling in 3 months, 6 months, or a year. And then sometimes we'll also value businesses where the owner just wants an idea, and that's okay too. If they're not looking to sell today, we do offer free valuations, and so that's just one of the services that we have to deal with is people who might not be ready to sell or might not ever want to sell, but they want to know what their business is worth. So it's important to know that so that you can shape what questions you ask and what financials you look at around the time period they're looking to sell. So an example would be like interest rates. If you're going to value a business to sell in 6 months or 8 months or a year, and like today it's 2022, and they're about to raise interest rates again, is what people are expecting. We need to know that because it's going to affect how much money someone could pay for the business. So move on to the next slide. So going through the steps in the valuation process, and this is just designed to give you a high-level overview of some of the things we'll talk about and get you thinking about the steps that are involved as a part of the bigger picture. So the first thing we'll do is gather the required documents from the seller. This is going to be things like tax returns, P&Ls, balance sheets, and a list of questions that help us get started analyzing the financials. Then we're going to take those financials and we're going to plug them into an Excel model that is synced up with the presentation so that we have a place to analyze those financials, and it gives us the tools we need to dig in. Then we're going to take the data that we just plugged in and start to do a preliminary recast. And a recast is just a fancy term for finding that SDE or EBITDA. Once we get a good idea of what we feel it's going to come out to based on the information we have, we'll come up with a list of questions. Things, for example, like, hey, your depreciation went from $100,000 this year to $350,000 this year, or it was $100,000 last year, now it's $350,000. Can you help us understand why, what's going on in your business? Those types of questions. When we get the answers to those questions back, we'll take them and do the final recast. And this is us going through and making sure that every question is asked and we have a really good idea of what the cash flow is for every year for the last 3 years. And then we're going to take those financials and compare them and say, what's a good weighted number to use? So if last year was $1 million and the year before that was 500,000, we have to decide, is it going to be, do you use $1 million? Do you use 750,000 or somewhere in the middle? And then once you find that number, we're going to do the comparable sales research, which is using the comp databases to come up with the multiple that will be applied. So this would be going in and trying to find similar businesses in a similar industry of a comparable size, and then taking that data and applying it to the earnings to come up with an estimated value. And that kind of goes into number 8, putting it all together. We will then look at that value, put it into what's called the buyer test method, and just kind of sanity check it to make sure that everything makes sense. Sometimes you'll get a value that isn't congruent with the type of business, or might not work for the SBA 7A program, and that's the most likely path for that business. So you have to sit back, take a step back, look at the business. Would somebody pay this? And kind of check all your assumptions. All right. So in the next video, what we're going to do is dive into SDE in detail. So seller's discretionary earnings is one of the most important concepts and can be sometimes difficult for people to grasp because it is unique to valuation and it has some nuance to it. So we'll go into detail in the next video on how to calculate SDE. Then in the video after that, we'll do the same for EBITDA, and we'll talk about adjusted EBITDA, how SDE and EBITDA differ, and then how you can pick between the two. Then in the video after that, we'll talk about, or we'll go through a full in-depth recast. So we'll take business financials. I'll take actual tax returns from a real business, gray out all the information that isn't public or that we can't put on YouTube, and I'll walk you through exactly what I would do in a typical valuation to get the sheet loaded up, and then go through and say, okay, these are the questions that I would have. And then we'll, after that, dive into more topics. But this is just kind of what I had thought at the beginning. If you have any specific questions or anything, feel free to throw them down in the comments or shoot me an email. And then also, definitely check out the MidStreet blog if you're interested in valuation or small business sales, whether it's questions about due diligence or the process of selling a business. We publish content 3 times a week that's really designed for sellers or buyers or people who are interested in just brokerage in general to try to help them understand the topics and the things that we're dealing with every day. But again, if you have questions, my email is jeffjr@MidStreet, or if you're a team member, feel free to just send me a message on Teams and we can chat. So thanks, and I'll see you guys in the next video talking about SDE.